Let's talk money with Mary Holm. And as I introduce her, I realise that I do not have your notes in front of me, Mary. So let's just freeform it. Let's talk about Saturday Night Fever. Was that a significant movie for you?
Yeah. Not deeply significant, but I certainly remember it in the music from it.
And John Travolta on that lit up dance floor.
And how back then he seemed quite appealing, you know.
He was still appealing in his own way around the Pulp Fiction days, wasn't he?
Yes, he was.
Okay.
He was indeed.
I know, I'll just find your notes now, Mary, and I know your topic, which is the share market in New Zealand. Is that where we should start?
Yeah, and I just wanted to say a couple of things up front, that I'm not trying to put people off investing in shares, and absolutely not. And in fact, it's great that a lot more New Zealanders are in shares now than were pre-KiwiSaver, because everybody who's in KiwiSaver and anything but the really low-risk funds, they do have some investments in shares. In the middle level, the balanced funds, and then on up, the growth funds and the aggressive funds are largely shares. And so, and when you add to that people in retirement who are invested in shares, etc., it must be well over half the population of New Zealand has some share investments now. And I'm absolutely not saying they should get out of shares. And I'm also not forecasting what's going to happen to the share markets either tomorrow or in the next 10 years. Or I mean, it's a real fool's game trying to forecast.
Lots of people with money in shares, and I think even in the lifetime of our relationship, Mary, or in my relationship, we've sort of seen a bit of an attitudinal shift, right? When we first started doing this slot, it probably was about 2015. It's only 5 years ago, but we used to talk about the fact that people still had that hangover from 1987. Since there, we've had 5 years of rises in the share market.
I think so. I think, people who've taken any interest at all will have seen how well shares have done in the past decade, because it was the end of the decade. And I know some people argue that the end of the decade comes at the end of this year, but
come on.
But that's just silly, because 2020 has got the word 20 in it, so it's got to be.
You don't need to convince
in
me.
The 20s, yeah. So anyway, but so I've got the main points I want to make, and I've got to be really careful here not to just give too many numbers, because I realise over the radio, especially as opposed to in print, numbers are really hard to grasp. So I've got, in my notes here, I've crossed off half of what I was going to say.
Okay.
But the main points I want to make are that last year was exceptionally good in both the New Zealand share market and the world share markets. And last decade was pretty good too, overall. And the other key point is it was very lacking in volatility for the whole decade. The last year, have a look at this. I just brought this in to show you.
Thanks.
The Herald has got a graph of the last 12 months in the New Zealand share market. They run that regularly above their share column, and it's just steadily upwards with tiny little wiggles along the line for the last year. It's an incredibly smooth ride.
Because there was, it must have been about the end of 2018, there was a day of a big drop, or a couple of days, and we thought, here it comes.
There was a day of a bit of a drop, but I mean, relatively speaking, I think people were even panicking then a bit, because they'd got so used to the market just pretty much steadily increasing.
Imagine if you'd sold then, Mary. Imagine if you'd seen that drop and thought, it's happening.
Exactly. And some people will have. And, that's a real pity if they do. So just looking at last year for a minute, and we're looking at returns including dividends. I always do include the dividends in the return. I mean, some people, within KiwiSaver, you should be your dividends are being included anyway. Your provider is gathering the dividends and adding them to your fund. Outside KiwiSaver, people who directly invest in shares, some of them don't reinvest their dividends.
Sorry, can you give us 30 seconds on dividends?
Yeah, dividends. Dividends are a company. When you buy shares in a company, you are one of the owners of that company, even though you might only own a millionth of the company or something. You are a part owner of the company. And every year the company is hopefully making profits, and your dividends are your share of those profits. So it's a little usually a relatively small amount of money that gets sent to you each year per share you own. Dividend rates might be sort of 5, 6, 7%, that sort of range in New Zealand quite often. They tend to be higher in this country than in other countries for all kinds of reasons. But so it's kind of like the interest you would earn in a term deposit, except that it's irregular. It changes depending on how well the company's done.
So two ways of making money out of shares: you buy low and sell high and make the profit, and you get these sort of annual payments.
The dividends. Except for companies, fairly new companies often aren't issuing dividends because they're not even making a profit yet. And you see that particularly with tech companies and things like that, that they're actually taking investments
hungry for money.
Yeah, and they need it to grow, and they're not making any profit quite often for years. And people are in them just hoping that in the end they will start making huge profits. But generally speaking, most shares you get a dividend on most of the time. And so I always include dividends in the returns. It's like including rent in the returns on a rental property. It's that sort of thing. And in New Zealand shares last year, the return was 31%, which is incredibly good. Incredibly good. After tax, it was about 30% because of what they call dividend imputation in New Zealand, which is where the company's already paid tax, so shareholders don't pay tax again. Because of that, there isn't a lot of tax being paid, and so the after tax and before tax returns are very high. 30% is an incredible return.
It's like investing in some banana republic in South America.
It is, and it's the kind of return that people at times have made on rental property, and everyone gets very excited about that. But for whatever reason, these huge returns in shares have not really been on people's radars much.
Yeah,
you don't sort of see people getting very excited about it. Certainly not like they did in the early 80s in New Zealand before the crash, when people got very excited about shares. I'm not saying we want to return to those days because that was crazy stuff, but I am saying that people who are invested in shares or anything other than a very low-risk KiwiSaver fund did very well last year. And on overseas shares, it was 28%. So New Zealand was 31 and overseas was 28. Both fantastic returns.
I guess we have President Donald Trump to thank.
Absolutely not.
He seems to be taking a lot of credit for the...
Look, I don't think he can take much credit, but I'm not an expert on that. But I think, I mean, for one thing, this is all overseas shares. It's not just American. We're talking European and British and Japanese, etc. So I don't think that's all certainly thanks to Trump. But in any case. So that's the 1 year returns.
I had a Trump supporter email me this morning arguing that I wasn't giving him enough positive coverage, so I thought that was an opportunity to give him a blow.
Yes, look, okay, we'll say it was all down to Trump.
Okay.
Keep that person happy.
Yeah.
Over the 10 years, so...
Hi, Gordon.
Do we call them the teens? You know, when we look back in the 20th century, I mean, we have the 20s and 30s and 40s, but we don't tend to have a name for the...
No, 2010s doesn't sound quite right, does it?
No, but I thought maybe we could call them the teens, for 16, 17. Anyway, and that over that whole decade, the average return for New Zealand shares was 15% a year, which is still awfully good. It's excellent, and overseas it was 10%, which is compared with, say, the decade before, when the global financial crisis came along, returns were a lot lower than that. So the whole decade was really good, but in terms of numbers. But then looking at volatility, which is also a really important factor, how much the markets wobbled around, because we've been taught that volatility and high returns go together, that if you want to go for high returns, such as in shares or property, you've got to expect volatility. And in fact, we didn't get much last decade. It was, I got some data from an actuarial firm called MCA, and they do a calculation on the volatility, and the numbers for the last 4 decades are in the 80s it was 28, in the 90s it was 18, in the noughties it was 13, and last decade it was 10. So the volatility has gone down and down and down in recent decades. No reason to think that means it's going to keep going down, though. That's not. It's just seems to have kind of happened that way. And when you look at bad stuff that happened during the decades, in the last decade, in New Zealand, we only had 1 year when there was a negative return, and that was only slightly negative. It was minus 0.5. It was tiny. Whereas if you go back into other decades, the worst year in the 80s was minus 44% in the share market crash. So your share investments nearly halved. In the 90s it was minus 35, and in the noughties it was minus 32, and last year it was minus less than 1. Last decade. So what I'm saying is it was very smooth, and there was hardly any downturns at all. They were just little kind of flickers down, which is just so extraordinary. Moving on to what that means for people. Don't drop your shares, because Mary has said they've been extraordinarily good and it can't continue. I don't know. It might continue for the next decade. Volatility might stay down and high returns might stay up. We don't know. It's just that when you look at history, the chances of it continuing for another 10 years are awfully low. Who knows what will happen? But the key thing with share investing is to have that 10-year horizon we've talked about before, of knowing that you've got 10 years before you are planning to spend the money, 10 or more, 20 or 30 if you're young and you're in KiwiSaver. It's terrific if you've got those long horizons. If you are investing money that you plan to pull out in a few years to buy a house or go on a trip or something or other else, don't put them in shares saying, well, look, if I look at the last 2 years, the returns were terrific or whatever. So need my money in another 2 years, so I'm going to put it in there and get another 31% a year on it. Well, you might actually see your money drop. It's quite feasible over a short period, quite likely. So please don't do that. The other key message is, when you see the markets going down, don't panic and bail out at that point. Don't sell your shares if you're directly investing in shares. And if you're in KiwiSaver, don't say, oh gosh, helps. This is my balance was 50,000 and it's now 30,000. That might happen. Don't go to your provider and say, look, I can't cope with this. I need to move to a lower risk fund. What you've got to do is think now about whether that would make you panic. Picture your KiwiSaver balance halving, because that is possible. Picture that happening over perhaps a fairly short time. And if you think, gosh, I really couldn't cope with that, move the money now, today, ring them up today, into a lower risk fund, because then you are moving them while they're still worth a lot. The shares currently are worth a lot. So moving the money now, selling now is fine. You're effectively selling if you move to a lower risk KiwiSaver fund. And selling now is fine. But selling after it's gone down is absolutely not, because that's when you make those losses real, and it's a horrible thing. Yeah.
Great advice. Someone says, and I should point out that Mary can't cover every single aspect of a topic on a Thursday afternoon. Someone says, Jessie, dollar cost averaging is the key to long-term share market investments. No need for doom and gloom commentaries. Buying regularly into a well-structured portfolio is key. Get Mary to share this gem of investment gains.
Yeah, I've certainly talked about it in the past.
She has.
But just very briefly, it's basically what happens if you put the same amount into a shares or a share fund on a regular basis, like $100 a month or whatever, like that. And in KiwiSaver, you're doing that anyway if you're an employee and you're regularly putting money in. And it means you actually buy more shares when the prices are low. So we could go into it in more depth sometime, and we probably will again, although, as I say, we've done it before, but Yeah, it's a good point.
You can find all of Mary's previous talks on our website, rnz.co.nz. Go to the podcasts page and you'll see her lovely face there. And she has her own website too, maryholm.com, where she collects her columns from the Herald and other writing that she's done. Thank you.
It's a pleasure, Jesse.
It's Mary talking money.